please feel free, if you have some questions, to move to one of the mics, and we will start. I'm going to start right here because this gentleman has a question right here.
This is a general banking question. When banks make mortgage loans, they create the principal and not the interest. Where are the homeowners supposed to find that interest in order to avoid foreclosure?
With due respect to Kurt's dictum to keep questions short, it would be helpful to me if you elaborate a little bit more about what you have in mind. Thanks. No, that'd be helpful for me. Thanks.
Well, when someone takes out a mortgage, they have to pay back the principal of the mortgage. That principal, I understand, is created at the time the loan is made. But the interest that accumulates is not created by the bank. And it is up to whomever took out the loan to find that interest someplace. And my question was, collectively, where do the homeowners find that interest to avoid foreclosure?
So, okay, I think I have a better understanding of the question. Thanks for reformulating it for me. So, I think that this really gets to the heart of what the Fed's policies are about here, that it's going to be easier for borrowers to be able to afford the interest charges that they have on their mortgages if their incomes are higher. And that's going to be higher, it'll be easier for them if they have jobs. And that's going to be coming from the fact if we're better able to achieve the goals of maximum employment, we're going to be able to have borrowers in a better position to repay the loans that they've taken on. So I think that really lies at the heart of the Federal Reserve's policy of providing stimulus to the economy is in an attempt to try to do a better job of hitting our goals of maximum employment. If we hit those, the more we're able to achieve on that dimension, the better borrowers will be able to repay the loans they've taken out.
Did you have a question over here?
I have a question about the hurricane, something as newsy as that. Surely you guys have been discussing what the macroeconomic shock of that is going to be, and I think when I was looking at the news this morning, I was thinking particularly the fact that it hit our financial district in New York. Thoughts on that?
Yeah, thanks for the question. It's really, I have to say, too early to tell the full economic ramifications of what the hurricane will be. A general rule is that a natural disaster, while it just has huge human consequences, when you take it over the whole macroeconomy, as large as the United States, it wouldn't have an influence, much influence on such a large entity. With that said, as you're pointing to, this hurricane in particular, this storm in particular, hit our financial sector pretty, financial heart of the United States pretty hard. So I would have to say, I would hesitate to give you a firm number of what the consequences would be at this point.
I'm going to go back over here. Right, no, you right here. I'm going to go below here first, okay, and then I'm going to be on you next, okay?
Yes. Okay. My question is, with your goals of price stability and maximum employment, what influence does the Federal Reserve have in two areas that have been basically run away for the past 30 years? That's healthcare and college tuition. Is there anything where you have any influence in those areas, or do we rely on things like the Patient Protection Act to bring those costs back in line in healthcare?
So I think this is a good question as well, that there's a lot of influences in the economy that the Federal Reserve doesn't have control over. When we talk about price stability, we're talking about the behavior of a very broad base bundle of goods and trying to keep that price relative to dollars growing at a constant rate over time, so 2% per year. You're describing that there have been very large relative price movements. So some goods have become extremely expensive relative to what they were 30 years ago. That's just not something that's really in the purview. That kind of long-term changes in relative prices, not something that monetary policy can really have much impact on.
I'm going to go up here then.
What do you think is the natural rate of unemployment? And once we get there, what regulations can you put in place to prevent another recession?
Well, those are two great questions, and I only wish we only have a short time to deal with those questions because you can teach a course on both of them, I think. So let me talk about the natural rate of unemployment. I think this is a very challenging question, so let me first define what I have in mind when I answer it. So by the natural rate of unemployment, I'm thinking about what the unemployment will be in the long run that's consistent with our 2% inflation target. So that if we get inflation running at 2%, follow a policy that's consistent with that over the long run, what's the unemployment rate that will be associated with that? And at different points in time and in different economies, the answer to that question is different. Right now, the Federal Open Markets Committee offers estimates to the public of what they see the natural rate to be. And those estimates range. There's different people on the committee, but the central tendency, so you look at the middle 13 of the 19 people I mentioned, their estimates range between 5 and 6%. So that's considerably lower than the 7.8%, which is the current unemployment rate in the United States. So that means that those estimates imply that we can see unemployment fall back down to between 5 and 6% without generating inflationary pressures above 2%. Now, this is a change because if you go back to the pre-recession, so 2007, the FOMC's estimates were more clustered below 5% for the natural rate of unemployment. So their estimates have risen over time. It is a challenging process to continue to stay on top of that. But the main clue, I think, for figuring out what that natural rate is tracking what's going on with inflation. As long as inflation is staying as low as I've described and our expectations for inflation staying as low as I've described, then I think we can have some confidence that we're still not at that natural rate in terms of unemployment. Okay, so that's on the natural rate of employment. As I say, there should be a course called the natural rate of employment, and you have 15 weeks on it. Everyone here would sign up, I know. The second question about what kind of regulations that we can have to prevent a recession. You know, I think that to a certain extent, recessions are part of what happens in a capitalist economy, in a competitive economy. That shocks hit the economy, and output will go up and down in response to that. I think the kind of recession that we had in 2007 and 2008, though, I think there you can see that there were excesses taken in terms of risk-taking in financial markets that it certainly amplified, at a minimum, the shock that hit the U.S. and really hit the world. And so I'm going to reinterpret your question to be about what kind of regulations could we put in place to control that amplification process. Well, the good news is we've taken steps in that direction already. There was an act passed in July of 2010 by Congress, named after the sponsors of the act, the Dodd-Frank Act. And that act is enormous. It's 830 pages. But I think there are two pieces of it I think that are very important in particular. I think the first piece of it is that the act formed what's called the Financial Stability Oversight Council. And this is a group of 10 regulators and the Secretary of the Treasury. And this council now has the ability to isolate, to monitor and identify sources of systemic financial instability in the United States. Once identified along those lines, either firms or activities that are identified as systemically important, to use the language, will be subject to oversight by the Federal Reserve. So one of the problems that we had going into the financial crisis of 2007, there was a lot of activities going on that really nobody had a really good insight into what was happening. And this Oversight Council is I think, going to give us a better lens into that. The second piece of the act, which I think is very important, is that during the financial crisis in 2008, it was difficult, really impossible, to liquidate a large financial, systemically important institution without causing huge damage to the U.S. economy. And this is something that happened when Lehman Brothers collapsed in September of 2008. It had big effects on the U.S. economy and on the global economy as a whole. The Dodd-Frank Act has what's called an orderly liquidation process in place that puts together a framework under which we will be able to liquidate a large financial institution, a systemically important financial institution, in such a way that the activities that institution is taking on that are systemically important will be able to be taken on by some other entity in the economy. So we don't have to face the same concerns, the same costs to the economy of liquidation. Now these are, I think both of these changes are still in their infancy. I described they were passed really just over 2 years ago. But I think that over time, they will make us much safer against the possibility of the kind of shock that we had in 2007, 2008.
I'm going to go down here.
Some of the people that have criticized the Fed for its financial transactions have added that they think we should go back on the gold standard. I thought you might like the opportunity to respond to that.
Well, thanks for the question. I think, so let me talk about what the gold standard, the way, people use the term in a lot of different ways. And I think it's, the way I understand it is that we would peg the value of the price of gold in terms of dollars. And that would be, you know, what that would have to be, what that would pin down what monetary policy is supposed to be about. And I think the challenge with the gold standard is really well illustrated by the events of the past 4 or 5 years. When you're on the gold standard, it really puts a limit on how you're able to conduct monetary policy so as to buffer the economy against shocks. And so I'll talk about 2 different examples of that. One is that in 2008 and 2009, the Fed was able to, I think, inject a lot of liquidity into financial markets. I think it prevented the crisis from being much worse than it would have been otherwise. On the gold standard, in the 1930s, the U.S. was not able to do that. And that made that shock much worse than the one we went through just now, unemployment going to 25% and deflation of over 10%, deflation, so negative, so prices falling over time at 10% a year. And that comment about deflation gets me back to another issue with the gold standard. And again, it's, I think, well illustrated by the events of what we've just seen, that when times are uncertain, as they are now, as they were in 2008, people run for safety. And one of the assets they've run to historically is gold. So the price of gold has gone up a lot over the last 4 or 5 years. Now, some people think this is because of inflationary pressures, but you can look at inflation-protected securities issued by the treasuries. You don't really see any evidence that people are worried about inflation there. The price of gold is being driven by the fact that people are scared. They're nervous about the future. If we had had the value of our dollars pegged to the price of gold, that would mean the prices of everything else would have to be falling over time because gold has gotten so valuable. So that it would mean we'd have the kind of deflation we'd had in the Depression would be exactly the kind of deflation we would have had over the last 4 or 5 years. That would have been hugely debilitating for our economy. So I actually think that the events of the last 4 or 5 years are a very good example of why countries have abandoned the gold standard and gone to the kind of central banking system that we have in the United States, roughly speaking.
I hope people are not being intimidated by these fancy chairs. So, please, if you have a question, ask. I'm going to go back over here again.
Okay, I have 2 questions. The first one is, we know that based on the recent report of National Economic Research Center that GDP for third quarter was 2%. But, so this is slightly higher than 1.2%, which was in the second quarter. So it seems like we are kind of recovering, right? So we have some positive signs of recovery. So my question is, what do you think about the state of U.S. economy? The second question is, what is your comment about jobless recovery?
Okay, so these are both good questions. So let me talk first about the state of the U.S. economy. From December of 2007 through June of 2009, so this is what's called the Great Recession now. During that time period, real GDP in the U.S., which is all the output being produced in the U.S., corrected for the fact that we've got to correct for the rate of increase in prices. When we do that, real GDP fell in the United States over that time frame by 5%. Usually, we grow per year between 2.5% to 3% a year. So really, if you take a look at June of 2009, we were 10% below where you would have thought we would have been if you've been thinking about things from forecasting forwards from December 2007. We were 10% below where we would have expected to be. Now, I think in general, after recessions, if you go back over the post-war period in particular, what happens after recessions is we grow faster than normal, faster than the 2.5% to 3%, because we're catching up on that gap. That 10% gap starts to erode over time. We have not seen that kind of catch-up. And in fact, our growth has been slower than average over the last, since June of 2009. And that means that actually we've created even more of a gap. We're actually closer to probably being 11% down as opposed to 10% down, as I mentioned in June of 2009. So the question you asked about that we're recovering, you know, positive is better than negative, absolutely. But boy, 2% when given the hole that we've had, we would like to have seen faster growth than 2. We would like to see faster than 2.5 to 3 because we want to make up for that gap that I've talked about. So all of that's in terms of output. And you see the imprint of that in what's called the employment population ratio. So this is the fraction of people over the age of 16 in the United States who have a job. That was about 63% in December 2007 and fell by close to 5 percentage points over the until about late 2009. It has come up a little bit over the last year, but it stayed relatively stable. So I don't know if I would talk about what we've had as a jobless recovery. It's just the growth has been so slow in this recovery that we have not been able to create that many jobs. We're growing, the employment is growing at about the rate of population. That's better, as I said, than not. But you'd like to see more. If you had more growth, you would have that employment population ratio growing more rapidly.
Okay, I'm going to go over here.
When you discuss inflation at this point, CPI, how do you differentiate between, for instance, consumer durable goods versus discretionary, and what weighting is put on that?
Yeah, so this is getting into the details of the construction of the price index. So there's two different kinds of price indices that are commonly referred to. One is the consumer price index, and that's a bundle. Basically, you're trying to figure out a bundle of goods that are weighted by how much people spend on them. That's the rough principle that's at work. And so the Bureau of Labor Statistics has one weighting. What we actually usually use is what's called the personal consumption expenditure inflation rate. This is a broader basket of goods. But again, the principle is the same. You're trying to weight the goods in the basket by how much is being spent, on it. So housing will get a bigger weight than fuel in the consumer price index because of the fact that people spend more of their money on housing services than they do on fuel. So that's all of this has received a lot of attention, a lot of research over the years about exactly how to do these weightings. There will continue to be research about how to do it, but I feel pretty comfortable. I would say that people are doing as good a job as we know how to do at this current time on both these price indices. Yeah.
You're going to go back over here?
I wonder if you could comment a bit on the dual mandate of the Fed. What type of time frame are you looking at? If your vision is too short, does it not potentially generate the fiscal cliff that is being discussed at this time?
So I guess I'm going to ask you to elaborate a little bit more as well on what you have in mind.
Okay, I'm not an economist, but a lot of news articles are talking about the fiscal cliff. Maybe you could just enlighten me on that.
Oh, sure. No, that I'm happy to talk about the dual mandate and the fiscal cliff, but I wasn't sure how to put them together into one answer. So let me talk about the fiscal cliff, that essentially the current tax code has in place a number of provisions that would lead to cuts in spending and increases in taxes in the early part of 2013. This will push downward on prices and employment. So from the Fed's point of view, this would be a problem. You would have a lower employment, so higher unemployment, and downward pressure on prices when we're already running below 2%. Now, I've already talked about, when I talk about monetary policy, it's important to keep in mind, and the conversation often about monetary policy often forgets this. We cannot make monetary policy today to influence the first half of 2013. It doesn't work that way. It takes longer for it to influence the economy than that. And so that's why I made reference to forecasting things out 1 to 2 years. So it's only if this fiscal cliff that I made reference to, the cuts in spending and the increases in taxes, if that had an impact on what's going to be happening 2 years down the road, that would be problematic from our forecast, and it would necessitate a change in our current policy stance. But I think the fiscal cliff is a risk to the U.S. economy in 2013. I am optimistic that the Congress will be able to make the necessary changes in the tax law, that we will not have that go over the cliff, to use the vernacular. That in fact that we'll have the kind of growth experience, even probably have a better growth experience than we've had in 2012, slightly better. So my own baseline forecast for the U.S. economy is that we'll be growing at around 2.5% in 2013, which is, as the earlier questioner asked, is slightly faster than where we are right now. So that's my baseline forecast, but that does require the two sides to get together over the next few weeks to get things fixed.
I'm going to go back over here.
Yeah. Is it true that in 1913, off the coast of Georgia on Jekyll Island, the congressmen were bribed by the international bankers, in particular the Rothschilds, and they got control of the Federal Reserve System, and they still do? Could you comment on that? Because that's illegal for any private entity to control and own anything in the government.
Well, yeah, thanks for the question. Frankly, I think it's always good for people to be interested in the history of the Federal Reserve and how it started and where it came from. And so I think it's good for people to be interested in those questions. But for me as a policymaker today, I'm interested in what's happening going forward. And the way I look at the Federal Reserve right now, and I look at you, I'm looking at the owners of the Federal Reserve System. As taxpayers, you're the owners. And there's two ways to think about that. One is that any profits that we make on our asset positions, we remit them to the Treasury Department. They help defray the deficit. So that's one sense in which you're an owner. The other sense in which you're an owner is the Congress of the United States can change the Federal Reserve Act at any time and do whatever it wants to the Federal Reserve System to change. In fact, the Dodd-Frank Act contain changes to the Federal Reserve Act. So in both senses, the true owners of the Federal Reserve System are the people of the United States. And I think that's exactly appropriate. That's the way it should be.
Yeah, but you're evading the question. Do they still control it?
I'm going to go to this question here.
Yes. Last several years, the Eurozone has been having financial issues, mainly Portugal, Italy, Greece, and Spain. And I'm wondering the effects that this could have on the United States, as if Spain, Italy, or one of these countries were to collapse, as they have little control over their own currency right now since they're all pegged to the euro.
Yeah, it's a great question. So let me talk about Europe and the kinds of risks that I think that Europe poses to the U.S. and to the world. Right now, Spain in particular is in recession, but Europe as a whole is certainly going through some tough economic times. And so this imposes effects on the U.S. economy because that means their demand for our goods is lower because of that. Their demand for our exports declines. That puts downward pressure, on demand for our goods puts downward pressure on how many workers our firms our business want to hire to make those goods. So that's an adverse effect on the U.S. economy, but that actually turns out to be relatively modest. And the reason is that trade, we're a big country. Most of our economy is domestically focused. And so trade is relatively small, and then trade with Europe is, again, a smaller fraction of that. So that the worries about Europe have been about financial spillovers, financial contagion, that people will become afraid in Europe, and that somehow that will affect people's fears about our own banking sector. And that's I think, the concern that people have had about Europe. I think that we have seen over the last 2 years positive movement in Europe, positive changes. And I think we've seen positive movements in our own financial system that to give us confidence that it would be able to withstand an adverse shock in Europe. So what's a good piece of evidence for that? So in March of this year, the Federal Reserve released the results of a stress test on the large financial institutions in the United States, the 19 largest. And one of the pieces of that stress test, which is about how will these institutions fare if things go really badly, and I can tell you the stress was very severe that was contemplated. And included a European, part of that was problems of the European financial shock hitting the United States. And the banks have enough capital in place to withstand that kind of shock. So I think those are the kinds of tests that we should be doing to make sure that our financial system is insulated against that kind of European disturbance. No system is perfect, but I feel more comfortable than I did, say, in May of 2010 on this dimension.
Come back over here. Oh, I'll go up. Okay, I'll go up here first.
The yield on one-year treasuries today is, I believe, in the neighborhood of 0.5%, 0.5%. Inflation is running at, or expected to run around 2%. So why have investors bid up the prices of treasuries so high that they have a negative? In other words, what happened to the Fisher effect? And second, instead of using the LIBOR, which has been in the news quite a bit, why don't we observe a rate in the marketplace and use that as a benchmark instead of LIBOR? Just observe a rate in the market instead of having to ask British bankers.
Yeah, let me talk about the first question. The second question, I'll just say frankly that it's pushing me beyond what really something I have a tremendous amount of knowledge about, so I don't feel really comfortable answering it. I think there are a lot of costs and benefits to the suggestion you put forward, and I just haven't done the careful enough analysis to offer you the kind of good answer your good question deserves. So let me talk about the first question about the negative real interest rate. And this gets to the heart of what we're facing right now, I think. What's happened since 2007 is there's been two kinds of changes in the world, really. One is the shock to wealth and to incomes in the United States and around the world has reduced demand. But there's another kind of shock, which I think is really important, which is the shock to certainty. That people are nervous and worried about the future. And when they're nervous and worried about the future, they want to save. They want to have a buttress, a buffer against those kinds of things that could happen to them. Notably, a reappearance of 2008. They want to have a buffer against that. And when I say people, I mean businesses and households, both. At the same time, so everyone wants to save more. At the same time, we have the problem that the supply of things that are considered safe to save with has gone down. So one thing that everyone thought was safe, speaking personally, was our houses. We thought those were safe kinds of investments. And those fell in value across the United States, but really in Spain and Ireland, the same kind of fall in price took place. That, to lose U.S. residential land as a source of safe assets for the world is a huge shock to the supply of safe assets. We were just talking about sovereign debt. Well, the debt issued by various governments was perceived as being safe 5 years ago. And, some governments not as much. So what's happened is that people are running for the safety of safe, for the limited set of safe assets, there's a huge demand for. That's going to push up on the price of them, push down on their interest rates. I think you could go out a little further in the yield curve. You go out to a 20-year Treasury inflation-protected bond. So this is something that's protected against inflation risk. The yield on that is 0%. So what does that mean? That means people are willing to give $1 today for $1 of purchasing power in 20 years. That means that they're very nervous about circumstances even 20 years down the road. So I think that's important to be thinking about, that downward pressure on interest rates that we're getting from the pursuit of safety really has had a big impact on where we're seeing in monetary policy, because the whole game of monetary policy is try to facilitate that downward force on interest rates by moving our own interest rate down. But hit down into this bound that we've got our target interest rate is between 0 and 1/4 percentage point, as I described. We would like to make that lower, given the situation we're in, but we can't. And we would like to make it lower to try to keep up with this downward pressure on interest rates I've described coming from around the world. So I think the fact that interest rates are as low as they are, as you pointed to, is a symptom of the kind of lack of certainty and lack of security people feel about the future, their futures. Going forward, I'm optimistic. I think you start to see some amelioration on these fronts. I think you see consumer sentiment is better in the United States than it has been in quite some time. So I think that is a start of people feeling more secure about their futures. You'll start to see some upward pressure on interest rates, and this will be a very good piece of news. 5 to 8.
I'm going to go over here.
I think you were the one who's supposed to be the
I
timekeeper.
don't have a watch.
How many methods are there for the Federal Reserve to create new money? Could you explain that?
So I think the main way we do this, that when people talk about the Fed creating money, what they have in mind, I think, by and large, is that we bring in reserves, deposits from banks. These are called bank reserves, and those are what we use then to finance our purchases of the long-term assets that I've talked about. So our purchases of longer-term assets, we've done two things. One is we had a bunch of short-term securities, as I described, in 2007, about $900 billion of those. We've really reduced our holdings of those short-term securities. And then we've bought longer-term ones. But the other way we financed it is by the creation of bank reserves. And those are much higher than they were in the past. There's a real question about whether or not we should call that money or not. And this is the kind of metaphysical thing that economists love to get into. But the reason I say that is that those accounts are not being used by banks then to go out and lend. They're just being held as excess reserves with the Fed. They're just sitting there in some sense. And it's only if banks start to see a lot of good loans and start lending those reserves out, that's when you would start to see them really becoming money out in the economy. So right now, I just think of them as being reserves that are being held with the Fed. Now, a reasonable question to ask, and certainly I get asked it all the time, is when conditions improve and the Fed starts to make loans, the bank starts to make loans, won't that create inflation? And the answer is that there's a couple things we can do. We can reduce the amount of reserves, if we were to choose to, by selling off our assets and buying them back. Or what we will probably end up doing is raising the interest that we pay on those reserves. And that'll keep the banks holding them in place with us as opposed to trying to go out and make loans with them. So to cut an overly long answer shorter, what we've done is we've funded the purchase of our longer-term assets by creating bank reserves. Those bank reserves are not becoming money out in the economy because they're just being held with us right now.
Is there another question? The top, the balcony, no questions? I'm gonna have this guy. I'm gonna let the guy in green go first. There's a question over here.
I understood that the Federal Reserve members were taking an inventory, or they were at the Balkan Shields in North Dakota. I can only surmise that they're taking an inventory. Is the Federal Reserve currently engaged in inventorying the United States assets?
I think the short answer, so I think you're referring to a trip that the Minneapolis Fed Board of Directors made out to the Bakken in August. So our Board of Directors went out there. So when I say our Board of Directors, who are those people? Those are, there's A directors, P directors, C directors. The A directors are representative of small banks that is a banker, representative of medium-sized banks that's a banker, and representative of larger banks that's a banker. That's one set of 3 directors. The B directors are members of the public that are elected by the state member banks of the 9th District. And then the final set, the C directors, are the ones that are appointed by the Board of Governors in Washington, D.C. This group of people, one of their primary functions is to provide me as a member of the FOMC with information what's going on around the economy, around the local economy. And they were very interested in finding out what's going on in the Bakken. We have a member of our board from North Dakota, so he's been telling us stories about what's going on in that part of the world. I had been out there to give a talk like this, and I was quite interested in what's going on there. So it's really about information gathering for us more than anything else. Try to keep track of what's sort of the assets of the United States. That's really the job of the National Income Product Accounts. They do the best job they can on that dimension.
I'm going to go to Green.
Yes, I was wondering how the Federal Reserve planned to unwind its mortgage-backed security balance sheet once the economy improves.
Okay. So this is a good question. We have holdings of a number of securities, and there's a couple of ways we can think about doing this, but we've actually talked about this. We laid it out in June of 2011. Turns out well in advance of when probably we're going to be in this position to unwind our balance sheet. But the way it would take place is that we would start. There's two ways it can take place. One is by they can be redeemed, so people can start to pay them off. They'll mature, or we can sell them off. So those are the two ways that can proceed. We're going to use a mix of both strategies when the time comes.
We're going to have 3 more questions. I'm going to start up there, then I'm coming down here, and then I'm going to finish with the guy that started. So let's go up there first.
Okay. In response to someone's question, you had said that cutting spending and increasing taxes would cause prices to decrease and unemployment to increase. Why isn't the government running a much higher deficit in order to offset the huge decrease in private sector demand?
Yeah, that's a fiscal policy question. There are costs and benefits associated with increasing the deficit. You're going to have to pay it off at some point, and that's a tension that the people on the fiscal side have to wrestle with. I was pointing to the short-term consequences of the tax code that's currently in place, the consequences it would have in early 2013, as estimated by the Congressional Budget Office. But you're asking a question that really is best posed, I think, to the makers of fiscal policy, and that's members of Congress.
In 2008, the Federal Reserve started paying interest on excess reserves. Do you see that as a disincentive to lend those excess reserves to the public?
Yeah, so right now we're paying 1/4 percentage point on those excess reserves, and it's definitely a disincentive to provide loans to the public, but it's a really tiny disincentive. It's 1/4 percentage point. I stated in my opening remarks that I think you could argue, if anything, that monetary policy is too tight. One way you could think about easing monetary policy in the current setting is by reducing that interest on risk reserves. But the room is so small there that it's not going to have much impact on the economy.
I'm going to go over here. I think there's going to be one more question over here, and then we'll do one last question here. Okay. So here and then there.
I'm presuming that probably everyone in here has at least a few dollars in their pocket, paper money, Federal Reserve notes, and my question is, what gives Federal Reserve notes their value?
Well, it's a good question. I think there's literally hundreds of pages of academic work on this question, and I've contributed my own. Refer you to a piece called "Money is Memory" if you want to look at it. But I think the conclusion, by and large, that people have come to is what gives that currency its value is that it's backed fundamentally by the taxes that are being collected from the citizens of the U.S. So that is what provides the backing for United States currency. If the Congress were to suddenly stop collecting taxes, or people believed that the Congress would stop collecting taxes, that would have an impact on the value of the dollars that are already out there. So that, I think, is really, I think, the conclusion, the most academic research has reached is that's really the fundamental source of value for U.S. currency.
I would say to my students, you know, well, I'll give you $1. I mean, you know, would you take it? And they say yes. And I said, that's what gives it value. You're willing to take it, and somebody else is willing to take it from you. So before we go to the last...
So you can see, you can get economists talking about this. You can go on a long time.
Before we go to the last question, I'd like to thank, first I'd like to thank everybody here for being so polite. So thank you guys. Give yourself an applause. Okay. I'd like to thank the outreach committee of the Duluth School of Business and Economics and their chair, Jim Skurla, because they had to put this together. They're working this tonight. They're working the mics, and so I'd like to thank them too. Okay. I'd like to thank Stephen Burgess and the National Bank of Commerce for sponsoring the LSBE Distinguished Speaker Series this year, so that's great. So thank you to them. And then a personal thank you, and I think we all want to thank Dr. Kocherlakota for his comments, and I'd like to thank him and his staff because I know they've done a lot of work too, so thank you to all of them. And with that, you get the last question.
I'd like to bring this down to a real human level. Since the Reserve Board or Reserve Bank is instrumental in keeping interest rates low, what do you say to people who have a desperate need to grow their savings, perhaps for retirement?
Yeah, I mean, it's a challenging situation. And so I think there are two answers that are related to give to that kind of question. I think, first of all, one of the big challenge for savers has nothing really to do with monetary policy. It has to do with the fact that there's such a huge demand for savings out there in the world. So I described earlier how there's enormous amounts of uncertainty and how many more people want to save. There's a huge demand for safe assets, and there's less of those safe assets available. Whenever you're trying to do the same thing that a lot of other people are trying to do, it's a basic rule of economics that the price you're going to have to pay for that is going to be high, and the yield you're going to get is going to be low. So that's the one answer. Now, how do I know that the Fed has not made interest rates too low relative to the problem I just described? And I know that because I'm trying to meet my goals as a Fed policymaker. My goals have been given to me by Congress to maintain price stability and to promote maximum employment. And I have to make my decisions about interest rates so as to achieve those goals. And keeping interest rates low, as we're doing, I think is the best thing we can do to achieve the goals that we've been set by Congress. I want to say thanks to everybody for just a great set of questions, really thoughtful, and I appreciate your taking the time to come tonight. Thank you very much.